Vetri Subramaniam joins us now. Let's take the conversation forward. Vetri, we're getting a mixed kind of a view on the market and what the budget means for earnings. There is one HNI section who's feeling rather disgruntled that FIs don't have to pay taxes, they'll have to pay taxes. There are veteran fund managers like you, we've spoken to some of them. They're saying, look, we cannot look at the dividend distribution tax from the eye of HNI. We have to look at what markets value them as. There is a scope for companies to give more dividend. And that means P multiples will get re-rated. So what is the right way to look at this? I don't want to use the word contentious, but this entire dividend distribution tax issue.
Yeah, good morning, Nikunj. To be fair, I think, this complaint is there all around the world that there is double taxation of dividends because dividends are also being taxed in the hands of the recipient. But, like it or not, I think except for one or two geographies, most countries around the world, including in the developed world, do charge the recipient taxes in their hands. I think as far as India is concerned, remember that the DDT was introduced many, many years ago, where they felt even from an administrative point of view, this was an easier thing to do because people may not have been reporting the dividends received and were not paying their taxes on them. That is no longer valid today when everybody has their holding through DMAT. It's linked to a PAN account and all the money is transferred digitally, and therefore it will be very hard for anybody to hide that income away. So I think in a way this is a desirable step. Also, I'd like to point out that increasingly as you see the markets get more and more institutionalized and there is public money coming into equity markets through, for example, the mutual fund route, or for that matter through other sort of such pension funds, etc. We are non-tax paying entities. So when companies were paying dividends, the effect of the DDT was that our investors and our structure, which was effectively a non-tax paying structure, was also suffering the impact of the dividend tax, whereas now it flows into our hands free of tax. And if investors stay invested in the growth option, they don't really incur any tax liability on account of the dividend. So I think as markets institutionalize, the fact that there is public money coming into markets through routes like mutual funds and pension funds, actually this method of taxation, of saying it is taxable in the hands of the recipient, I believe is very, very desirable.
Okay, how should one look at the entire coronavirus? It's something which will have global repercussions. Do you think markets are right or markets are justified in the way they have reacted, the way how metal prices, Chinese stocks, copper prices, everything has collapsed?
Well, we can argue about whether it's justified or not, but markets will do what they want to do, which is first price in the disruption. There are two ways of thinking about this, Nikunj. One is that, many of these stocks and most stocks in the market are trading not just on this year's earnings, but it's the cash flow that the company will generate over 10 years, 20 years. And maybe in that the coronavirus doesn't play a role. But the fact remains that, when we entered this year in January, there were hopes that the global economy would look up. The China-US trade war was behind us, and that things were starting to look much better at the margin for the global economy. I think what the coronavirus has effectively done is put a dent in those hopes. We don't yet have clear visibility. Hopefully, just like SARS or like in the case of the MERS, eventually we will find a solution, a cure, and things will come back to normal. But right now, I think it's inescapable that the markets will price in the disruption. Remember, this is the world's second largest economy. And, I think recent data suggests that things like fuel demand are down 20%, year on year in the last week, which tells you the extent to which that economy has, had to sort of go into a complete lockdown quarantine mode. And this is a country which is deeply attached to supply chains globally. So there is going to be disruption, and I think the markets will take that negatively, and that's pretty much what you're seeing. So, and also just to add one more point here, Nikunj, this is not the kind of thing that central bank policy can address, right? There are many things, including a trade war, where you can ask your central bank to sort of keep the liquidity pump open. But liquidity pump open in the case of virus doesn't really help.
Okay. So what are the green shoots in this market, Vetri, and where are yellow weeds? Where do you think there is an opportunity, and where do you think we would be wasting our time if we try to invest in that theme or in that company?
Let me put it this way, when you talk about green shoots, I think one of the things which is very evident is the complete collapse in credit which has happened over the last 18 months. And clearly, the sense we get from talking to a lot of companies, including, of course, the auto companies, but I see this across sectors, is that there has been a massive rundown of inventories across the board. So I do believe that, from here onwards, you will start to see numbers look a lot more normalized, because what we've seen over the last 1 year has been a inventory-led correction. It has been a inventory-led correction in GDP growth as well, and therefore that tends to sort of have its own self-healing mechanism in that once the inventory correction is over, you start to see numbers start to improve again. So I do think you will see some kind of a gradual improvement, but it's not going to be a dramatic U-shaped recovery or a V-shaped recovery for sure. I've typically tended to be more fiscally prudent and fiscal hawk, if you will, but I do think this was the one point in time where perhaps the government could not only have looked at the FRBM but really taken a call to sort of provide some kind of a demand side stimulus and use the fiscal deficit in a counter-cyclical manner. Now obviously that comes with the risk, like in 2010, that we kept the fiscal pump open for too long, but I think it was a risk worth taking. But government, in all its wisdom and perhaps prudently some would argue, chose not to do that, but it just makes the growth recovery therefore a little bit more delayed.
Would you look at perhaps increasing exposure to consumer names? I mean, they're already a substantial part of your portfolio versus, let's say, a materials or a technology at this point, given the direction that seems to have been set by the government?
So I hate to disappoint you on this, but I've been in this profession for 25 years, and it was a very, very long time ago where we reacted to the budget in terms of having to take a view on companies. That was the right thing to do 20 years ago, when with one stroke of a pen or a change in the customs duty, you pretty much wiped out or created the fortunes of a company. That really doesn't happen anymore in the budget, and therefore, I don't think there is anything in this budget which really causes me to go out there and restructure my portfolio. And I'm happy to have this conversation a month from you, and you can see whether my portfolio has changed. And it's been the case for many years now that we've not really seen the budget as a reason to significantly rebalance or change our portfolios, and I haven't really seen anything in this budget either that would cause me to dramatically reevaluate my positions either at a company level or at a sector level.
Where that exemptions are not going to be there. Now nobody knows that how much of the insurance inflow was coming largely because of this tax advantage. But generally, if we have to take a view on insurance based on the fact that exemptions in coming years will only decline, is there going to be a structural change?
I'm sure at the margin, when you take away a tax break, it will sort of put a speed bump in the growth of the industry. But having said that, I think what we really need to rely on is eventually the common sense of, every individual who's looking out for himself and his family. The most important thing is to put income in his hands, to create the jobs, for him to get those incomes. Once people have the incomes, Nikunj, they will do the right thing in terms of making those decisions, whether it is prudent for them to save more money, maybe for their child's education or for whatever else experiences they might want to have, including the risk of buying insurance, because that is the right thing to do to protect their family. So I think we have to trust the basic instincts of individuals to do what they think is right for them and the family, rather than presume that people will do the right thing only if you give them a tax carrot and a tax stick. I don't think that is the right way of looking at it, and it reflects too much of a statist mindset of a state which has to drive people to do some things. Now I understand the concept of nudge and getting people to do certain things vis-a-vis others, but we must also respect the individual and his income and his right to choose whether to consume or to spend or to invest. And I think people eventually do the right thing.
So Vetri, where are you on this debate of small cap versus large cap?
Yeah, that's an interesting one, Nikunj. So, if I look at the historical data, and I'm talking about, about 20 years of data, mid caps have historically traded at a discount to large caps. If you look at January of 2018, it was very unusual. Mid cap index trading at a massive premium to the large cap index. For the 5 years ended January 18, the mid cap index had outperformed the Nifty by an average of 8% per annum. Right? Highly unusual. Why? Because the historical outperformance of the mid-cap index over the large-cap index on a rolling basis, on a 5-year basis, is about 250 to 270 basis points. So this was an unusual 5-year performance, a massive outperformance of mid-caps over large-caps. We've seen that go into reverse gear over the last 2 years, massive underperformance by the mid-caps. And as a result, valuations of mid-caps have gone back into what I would call traditional territory, which means they are back at a discount to large caps. Now again, you need to take that with a pinch of salt, because when I look at the mid-caps, I see polarization there as well. There are some growth stocks, some more sort of stable stocks, which are trading at pretty expensive valuations, and others which are cheap, not too different from the large cap. But as a manager, what we've done over the last 2 years, wherever we had flexibility, and I'd say particularly over the last 6 months, is raised our allocation to some of those mid and small caps, because no longer is valuation blinking red, or for that matter orange. In fact, it's now saying things are back to sort of normal, back the company that you're comfortable backing. So on balance, we've been quite happy to raise our exposure to mid and small caps in recent times. As far as small caps are concerned, I would say the historical data suggests that it's a very, very volatile asset class, and it's not necessarily outperformed mid caps or large caps over a long period of time. Stock picking is far more important in small caps. Arguably, it's important everywhere, but I think in small caps, stock picking is a lot more important than just getting the cycle right.
Vetri, it's the most popular question on the street. Which is your next multi-bagger idea or theme? Now, I know fund managers would say, I don't know, I wish I knew, I will not be in the fund management business, I'll buy that stock and bet my house. That's a standard answer which I will get from a fund manager like you. But my job as a journalist to keep on insisting on that question. So Vetri, let me do my job of a journalist and ask you that question.
I'll have to disappoint you with the same answer, and it's been my experience over many years, Nikunj. The reason we work with an investment process is to identify the companies that are most likely to lose us money. As we eliminate those companies from our investment process and from our portfolios, we are left with companies which are blessed with attributes like strong cash flow generation, reasonably healthy return on capital, and somewhere once you've narrowed your focus down to that set of companies, from that will arise some of those companies which eventually go on to be multi-baggers. But it's very easy to sit here and talk about 2020 hindsight about how this company and this sector was most likely to achieve what it did with the benefit of hindsight. But sometimes what you realize is that over the next 5 or 10 years, things do change, managements change, their ability to execute changes, and therefore I actually believe that investing is more about exclusion. That is the science of investing, where you exclude certain companies, then you are left with a narrow basket. One of them will turn out to be that multi-bagger. Now the crucial thing over there is your ability to hold on to that stock both through the good times and the bad times. When I look at every multi-bagger that I've seen in my portfolio, and I've had this discussion with other friends in the industry and outside as well, it's not that they always went up. During the time they were multi-baggers, they also came down 30% in a given year. Some of them have come down 50% twice during a 20-year time span. So what really creates the ability, therefore, for a multi-bagger is your ability to hold on to the stock rather than your ability to identify it.
Vetri, we'll leave it there. Thank you so much for joining us and taking us through your views. As you said, not changing too much of your stance post the budget, and things are likely to perhaps look up from here on.